We got a good one. Today is a good one. Today is a video about credit. This is what I'm really excited. So most people, they don't have bad credit. What they do have is an incomplete understanding of what credit actually is, and that's a problem because that misunderstanding is leading people not to as much fiscal issues, but it's leading to delays in life. So what is happening is people are looking at their credit score and credit karma because they don't understand credit. They're delaying their life based on something that they don't even understand. If you listen to most conversations around credit, everything is really right now being reduced down to a single number. You need a 620, you need a 640, you need a 680, you need a 700, you need a yada 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 do blah 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 woo doo woo doo. Well, let me tell you, if you want to organize your entire timeline of your life around a number, you will not come out ahead ever. What you have to do is you have to think of your credit score as a summary of data. Now you're like, what does that mean and how is that different from a credit number? Well, I'm finna tell you how that is different from a credit number is when you think of it as a summary of data, you start to realize that when something is a summary and not a hard fact, things can be changed. You can influence a summary, you can't influence a fact. And a credit score is not a fact. It is a summary, and you can influence summaries. So you gotta walk with me. Because a credit score does not approve you for anything. A credit score does not explain your financial profile. A credit score does not capture your full report. A credit score simply represents how a specific scoring model interprets the information inside of your credit report. So you're probably like, how does that affect me and why does he keep saying it? If credit actually worked the way that people assumed that it did, then approval outcomes would be consistent. Everyone above a 580 would get approved and everyone below a 580 would get denied. And in a real world, in real world lending, that never happens. It doesn't happen like that because a number does not do anything but scare you. Oh, that was a good one. Okay, so the camera died and I had to go charge the battery, but I realized that I could go get lunch. So I went out and I had lunch. But I wanted to get back on topic because we actually have 2 videos to make today, so the camera battery dying really threw me a little bit off guard. But we're back. So I think we left off if I was talking about, okay, so I think earlier when I left off, we were talking about if credit worked the way that it does, like people assume that it did, outcomes would be consistent. If you had above a 580, you would get it. If you didn't, you wouldn't. But that's not how lending happens, yada, yada, yada. So let's get back to understand what's actually happening, you have to actually separate the system into its actual components, right? So a credit report, like I'm gonna put it on the screen, credit report. A credit report is the full record of your borrowing history. So we're including your accounts, your payment history, your balances, your collections, and how all of that information is reported across all 3 major credit bureaus. Your credit score is the model built on top of your credit report. So the Consumer Financial Protection Bureau defines a credit score as a prediction of how likely you are to repay a loan based on the data in your credit report. This means that your score is not necessarily the raw truth. It is an interpretation of that truth, and interpretations are subject to change. So also the one thing that I really want people to understand is that there isn't just one score. When you look at your score on Credit Karma, they're taking the collection of TransUnion and Equifax and they're giving you a score based on that estimate. It actually is really good for renters. If you're looking to rent, Credit Karma might be as far as you need to go if you want to get a close enough estimate to what people will see when they pull your credit score. But if you're buying a home, there are multiple scoring models, and you're looking at your FICO score, your Vantage score, and each model is weighing things slightly differently. But typically, if you're a mortgage lender, you're pulling the FICO score along with the 3 credit reports from the different agencies, and you're giving it your own internal risk assessment. You're not necessarily going based off what you see on Credit Karma or what another system tells you. You have your own internalized system. Now, this is why I say that a lot of times it's a lot better to go with a local banker in your local city or your community, because a lot of times if you just join your banker, they will actually align you with their credit reporting system, and they'll get you into their system, and you could watch your credit in the way that they would see it in their system. So they'll, like, if you have a credit union in your city and they have an app, they will, a lot of times in that app, you can see how they're looking at your credit score, which is a really good thing. You should really go with community banks. But once you understand that distinction and how Credit Karma is different from when you're looking at your credit card and they give you an estimate, and how that's different from when you go on transunion.com versus equifax.com versus experian.com, they're all different, but they're all reporting on the same information, and they're giving you different interpretations of what they're imagining your risk assessment to be. So that's why it's important to understand that a lot of these banks are doing the exact same thing, but they're not using public data. They're pulling everything all at once, and they're doing their own. Now you see that this is a strategy within a much larger system. Now we're not just talking about one number in particular. The thing that I always like to tell people is there are real guidelines. So I mean, you see people talking about, oh, you need a 580, you need a 620, you need a 640, 680, 700. A lot of times those different programs are really programs that they would like to attach themselves to or market on purpose. But in all reality, those programs are giving out guidelines, not restrictions. So you can go to a banker and maybe have a conversation that might give you a result that you didn't expect. For conventional loans, a minimum credit score around 620 is typically what you're looking at. A FHA loan, you're looking at 580. Sometimes they do dip below 580. If you have like strong compensating factors and a good down payment, you might be able to come in with as low as a 500. That's a very, very, very rare scenario. I do see it, but not that often. Those numbers are accurate, but frequently misunderstood. They're not approval thresholds, they're eligibility thresholds. And when you're looking at something that offers like 580 minimum, 3% down, you want to make sure that you're actually assessing whether not only you're eligible, but you're approvable within that program. And approval depends on how the rest of your financial profile supports or contradicts that score. Lenders evaluate risk using multiple factors. So you're looking at credit history, debt levels, your income, and your overall financial stability. This is why two individuals with similar scores can receive very different outcomes. So this distinction is critical, because at the end of the day, you have to stop chasing a number and start looking at your entire profile. And this is why I always tell people you should start any credit repair journey with looking at your credit report from all three bureaus. That's what everybody is doing if they're assessing you to determine if you can apply for credit. So that's what you should be doing. Don't follow the steps that the gurus take. Do exactly what the banks do, and they look at everything all at once. You need to perform your own internal risk assessment. You as a person, take out your notebook and perform a risk assessment. You need to look at what you owe, how much you owe, when are your minimum monthly payments due? Can you pay more? Can you pay less? Would you be penalized? You need to start assessing that and looking at that equation. Because once you start looking at how credit scores are calculated, the structure is actually pretty straightforward. So the FICO scoring models indicate that payment history makes up a large portion of your score, followed by amounts owed and your utilization of your available credit. The remaining factors include the length of your credit history and new credit activity and the mix of credit types you have. So what does that mean? The remaining factors include length of your credit history, new credit activity, and mix of credit types, alongside payment history and amounts owed or utilization. So this is something that I really want to get people to understand. They are very specific and not secretive about how your income should be broken down. Your payment history, not your income. They are thinking about that, but what they're actually thinking about is how you're. So the FICO scoring models, they're looking at pretty much everything, and they want to make sure that your payment history, your utilization, length of credit history, new credit activity, these are all things, mix of credit types that go into what make you a well-rounded consumer. Are you able to maintain different types of credit lines, and are you able to make a consistent and decent payment history? That's what people want to know. And the Vantage score model follows a similar logic. You're looking at payment behavior, credit usage, and the depth of your file playing major roles. See, what this means in practice is the credit is not really rewarding like effort really in a general sense. It's rewarding consistency. So if you're looking at your credit and you're wondering how can I get my score better, the real answer is the one thing you can do is remove inaccuracies and be consistent. If you can do those two things, you will actually win in a credit game that most people never even thought about. I think the making the payments on time thing is something that people miss a lot. They think that they can get behind and catch up on it later. It doesn't work like that. You would rather make a payment on time, and you're like, well, better late than never. The mechanics are very simple. They're often overshadowed by misinformation and miscommunication, but consistent usage and consistent payment history will have you beating out almost everybody else, with an added bonus of beating out the inaccuracies. Those three things will have your credit in a better shape than anybody else, and I promise you that. See, another thing that people might, I got a mirror right here, and I just looked, I don't know why I was like, ooh, girl, okay. Another thing that people might not understand is at the end of the day, you have to actually understand that credit reporting is not perfect. You have to be vigilant and stay on it. Credit reports are built from data from lenders, collection agencies, and other random groups, companies, organizations. That data can contain certain inconsistencies, and when accounts are sold between collectors or balances aren't updated correctly or information may not match across all three bureaus or the information that you have from the company directly itself. This is the main reason that we have a group called the Fair Debt Collection Practices Act. And this is the protection for consumers. You as an individual have the right to request validation of debts. It is not your responsibility to validate your debts. When you have a company claiming that you owe them money, they have to prove it. So let's say, for example, I'm a collector. I'm a credit card company. Call me Discovery. I'm Discovery Credit Card Company. You picked me up back in college. Look, back in college, you picked me up back in college. I'm Discovery Credit Card. I'm doing this voice because nobody likes a credit card. Nobody likes a credit card. Nobody likes a loser. Nobody likes a loser. So I'm Discovery Credit Card. You gotta walk with me. I'm Discovery Credit Card. I'm Discovery Credit Card. Nobody likes a loser. I'm a Discovery Credit Card. And at the end of the day, you picked me up in college. I know. Nobody believes it. I'm Discovery. You picked me up in college. At the end of the day, you didn't know all the rules. I'm Discovery. It's 10 years later. You're 25. You're 25. You didn't realize Discovery was still here. You got it. Pay Discovery. You gotta pay Discovery. Discovery is a credit card. You gotta pay me. But what you didn't know is, I'm Discovery. I run a really bad business. You didn't know this. I'm Discovery, and I run a really bad business. And I wanted to make sure you paid me so bad that I sold this debt. And I told them, hey, if you give me 25%, I'll count it even. You go get the money, you can keep the rest. That's what I told them. I'm Discovery Credit Card. Nobody likes a Discovery Credit Card. Nobody likes a Discovery Credit Card, yeah? So, you got me, you booked me, you spent me, you racked me up. But when I sold you debt, what I didn't tell them is, I got your name wrong. Your birthday and your name is wrong on the paper right there that I gave them. I'm Discovery Credit Card. I sold it to them 25%. You can have it. You can have it 25%. I run a really bad business. 25%. But here's a condition. But you gotta know his name's wrong. You gotta go figure out the name. And you gotta correct it before you collect it. Correct it before you collect it. I don't know. I run a really bad business. 25%. I'll take it. I'll take it. I know they're not gonna pay. I'll take your 25%. Go collect. Go collect. But what they didn't tell you is that's a really bad guy. Let me tell you, that's a really bad guy back there. That's Discovery Credit Card. That's a really bad guy. What Discovery didn't tell you is when he sold your debt, he got your information wrong. When he did that, he made a mistake. Because now he can't validate the debt because he got your information wrong. You put it right on the paper. You got all the documentation that says that's your name, that's your birthday. They got it wrong. Now you got to go validate that debt. And they bought it from somebody, so they can't go get the information to prove, no, this is the debt. No, we get validated. This is now you go under the Fair Debt Collection Practices Act. You go validate the debt. They can't validate it. It's their job to validate it. It's their job by the law. And you have the legal authority to collect that validation, to verify that the debt is accurate, that the amount is correct, and that they have the legal authority to collect it. What do? You handle that yourself. You don't go pay a debt. You don't go pay a credit repair collection agency to do something you can do yourself with one letter and one follow-up email. I'm telling you, here's what they do. I'm Discovery. I'm a really bad guy. I run a really bad, shady business. 25%, you know? Now look, you're back in business. If you didn't do one thing, you got one credit card up off your rear end. You better learn something. You need to go validate each and every single debt. Even if half of them come back as validated, you still got the other ones. You have to do this. You have to protect yourself at all costs. A lot of these companies are shady, nasty, and they're not getting your information correct, and they're selling it for pennies on the dollar, and they're not protecting your information. You need to go protect your information and fight for your rights as a consumer. Don't let these people get it wrong and then trample all over your credit score and prevent you from buying a house for the rest of your life. So yeah, in addition to that, you got credit reporting laws that require disputes be investigated and that inaccurate information be corrected or removed. These are not loopholes. They're not shortcuts. This, at the end of the day, is protecting your rights as a consumer to have accurate and verified information reflecting your ability to buy and purchase. You don't want to use it to cheapskate and to take the shortcut. No, but if you know that a piece of information is incorrect, or you know that they didn't validate it, or you got a notification that they sold off the debt and now it's at a collection agency, but they got your name wrong, your birthday wrong, social security number, you never got a piece of mail, you never got reached out to, so you don't even know if it's correct. It's just sitting on your credit report. Those are the things you go through, you dispute and you validate. That's the full sure method to get anything that is incorrect off of your credit report. You don't have to go pay some agency to do it. And understanding these rights are critical because it shifts you from an uninformed consumer to an informed consumer. It shifts you from not ready to buy to ready to buy. You understand what's yours, what's not yours. You understand what's impacting your credit. What do you have to pay back and what do you have to fight off? You need to know that. You need to become a consumer that's financially literate and understanding and ready to do anything to protect your financial standing. Because let me tell you something that they don't tell you. A lot of your favorite billionaires, millionaires, multi-trillionaires, looking at the world, sports players, Elon Musk, they filed for bankruptcy, they fought off debt, they went to court, they've done everything they can to get the debt out of their name. It's your turn. You're a small-time consumer. You need to fight it. Go to court. Do what you need to do. Don't take the cheap way out, because I promise you the cheap way won't win. You need to... If you're not willing to fight for yourself, nobody else will, and these companies will run you dry. I'm telling you that. Just let me tell you. So once you understand the system, the path forward is actually very much clear. It's what I like to call a 3-step process. Now, some people say it's not this easy. I say it's this easy. I've done it myself. My credit ain't perfect, but we're getting it up there. The first step is to obtain your full credit report from all 3 bureaus. Step number 1, full credit report from all bureaus. This allows you to actually analyze and get a tangible, accessible version of what you owe and what people claim you owe, and it allows you to strategize. How can I fight this? How can I figure this out? Boom. Now you got step 1 completed. From there, you identify inconsistencies. inconsistencies, inaccuracies, outdated information. You're looking at duplicate accounts, incorrect balances, accounts that cannot be properly verified. You're writing them down. You don't highlight, you don't take a pen, you don't upload the PDF to ChatGPT. You take it and you write it down in your notebook. The last step is happening in congruence with the second step. You are addressing behavioral factors that influence your profile. You need to reduce your utilization, establish on-time, consistent payments, and avoid new credit activity for now. This process is not about shortcuts. It's about aligning your credit file with the way that lenders are actually evaluating risk in 2026. You need to make sure that you align your beliefs with your actions, with what's being publicly narrated about you, and that is how you buy a home. Oh my God, people don't understand. I'm trying to help y'all so much, please. Oh my God, please, listen to me. So I had something in my eyes. And let me tell y'all something. The thing that the rich people won't tell you is, when you do all these steps, you go to court, you dispute, you fight, you demand validation, you require proof, you demand that this is proven, that beyond a reasonable doubt that this is your debt. Then you come up with a strategy to attack what you actually owe. And you get your credit down, and now you're, credit up, sorry. And now you're in a better financial position. You are accessing lower interest rates. You're accessing the best loan options available, lower monthly payments. These are the reasons that rich people spend all of their time working out their credit and not making more money. Because on paper, you can make $80K a year, but if you have enough credit to get whatever you want, you can get whatever you want. I think that the other thing that people forget is that payment history is just the biggest factor out of everything. If you can be consistent in your payments, you win the credit game, and take that to heart. It's also important to clarify the common misconceptions with credit. Carrying a balance on a credit card does not help you. Somebody had to say it. Y'all are taking bad advice from social media because you think that carrying a balance on a credit card helps you. No. Some dude on Wall Street said that 20 years ago, and now a bunch of 18 to 24-year-olds that think they're geniuses in financial literacy are keeping balances on their credit card, not realizing that that's actually holding them back from qualifying for more credit. Keep your balances low and keep your payment history high. If you pay on time, there's more value than proving you can hold a lot of credit at one time. Say that again. If you pay on time, there's more value than proving you can hold a lot of credit at one time. Remember that. The Consumer Financial Protection Bureau has made it very, very, very clear you do not need to carry debt to have a strong credit profile, but you do need to maintain consistent payments and consistent usage. That means that no, you shouldn't just go and have no credit cards, but you should also not go and rack up a bunch of debt and pay the minimum payment and say that you're building a strong credit profile. Both of those are wrong. What you need to do is go use your credit card, how you use your debit card, and pay your bills at the end of the month. If you go to the grocery store and you get $125 in groceries, you should pay $125 to your credit card bill at the end of the month. And maybe if you would like to keep your utilization up and you want to keep a little bit on there, maybe $25, $30, but you don't need to max out your credit cards and pay the minimum payment. That's not how you build credit. It's the worst idea ever. And the only reason any of you are doing that is because you found it on TikTok or with some other YouTuber. But what you didn't realize is if you don't have the discipline, all it does is increase your utilization and lock you out from getting more debt. And you're probably like, I don't want more debt. Well, if you want to buy a house, you want more debt. If you want to go back to school, you want more debt. If credit is fake, and we live in America, the richest country in the world, so we got access to credit and access to money and access to capital, we can build the world of our dreams. So why aren't you doing it? You need to buy a house. You don't need to go out and build a business. You just want enough to have a home, a homestead with some chickens and some grass and stuff. Ain't that what you want? You want freedom. That's what getting your credit up does for you. It gives you freedom, it gives you leverage, it gives you accessibility. And they don't preach this in school, they don't talk about it in college, they don't teach this once you get to your first job and you're making your first money. They don't give you these financial literacy tips because you are not meant to grow and expand and be free. They want you to be productive. But let me tell you, you can be productive and build a free and sustainable life at the same time. I'm trying to get you to do it. And this is how. I just gave you, in this entire video, I just gave you the steps. I gave you the steps on how to actually get better, do better, be better, present better. It's up to you if you're not going to take it. See, this is where I connect credit directly back to me in real estate, because when you apply for a mortgage, your credit profile is actually identifying who they think you are and the risk that they think that they're taking on. It not only influences whether you're approved, it influences the term of your approval. Your interest rates, your loan choices, your overall affordability is all tied into how they're evaluating your credit profile. And two individuals on the exact same home, in the exact same part of town, on the exact same day, in the exact same market, with the exact same purchase price, based on credit, can have two completely different financial outcomes. It's the difference between the young mom who's a nurse and has a bunch more credit on her profile but makes $80K a year and gets approved, versus the person with the 700 credit who has racked up so much utilization, has low consistent payment history, but it just so happens because they have access to so much credit that their profile looks good, that might not get the house. They are having two completely different financial experiences on the exact same deal, because one may have a manageable payment with room for flexibility, while the other may be operating truthfully at the edge of their budget. And this difference isn't created by the home or the market, it's created by the structure of one person's credit profile and how it's interpreted by the lender that they choose. You have to make smart, responsible decisions as a person to be a smart, responsible buyer. See, this is the most important shift, because once you start moving away from thinking about the number you need versus the profile you need, it gives you the ability to walk into a room, to walk into a bank, to walk into a lender with leverage. It gives you the ability to navigate a system that is very complex with understanding and there's I cannot think of the word. What's the understanding and what's the thing where you keep your head? Confidence. It's the thing that allows you to navigate these complex systems with understanding and confidence. Because when you understand how your credit report is built, now you understand how your credit score is calculated, and now you're thinking about how the lenders are evaluating you and your profile as a risk. It gives you the ability to stop making bad guesses, and you begin making very bold decisions with clarity. And that's the purpose of this series, My First Time Homebuyer University, is the idea of making and getting people to understand that clarity is leverage. You see how we tied that back in? You see the theme, how it's coming back in? Clarity is leverage, and I'm giving you all the tips. And I'm not giving you like, oh, this is how you buy a home, come buy a home with me. No. Yesterday we talked about the market. What's going on in Chicago? Why do people think it's so hard to buy a home when it's really not that hard at all? Now today we're talking about how to get your credit up, how to improve your credit profile. Later today we're going to be talking about, can you buy a loan with debt or student homes? And then next thing you know, tomorrow we're going to be talking about when will home prices drop? What mortgage rates are too high? How to buy a home in Illinois? These are all things that we're going to be touching on, and I'm super excited for y'all to be a part of the next few steps, because at the end of the day got to end, and I'm really excited that you all get to be a part of this First Time Homebuyer University. Now, if you want to get into the equation of buying a home with student loans, and maybe we'll talk about tomorrow monthly payment breakdowns for a 300K home in Chicago. I think that it's time that we start moving into the content. How can you buy a home? Can you afford to buy a home? I think that it's time for us to get there. It's Tuesday, tomorrow's Wednesday. Let's get to it. We're gonna be on it. So I really want to thank everybody I'm actually. I have a cellar league, so we're gonna get off of here today. I'm gonna reach out to y'all, and we're gonna talk about this tomorrow, and we're gonna see where y'all at and what y'all doing and how y'all feeling. Okay, hey.